Are US interest rates set to drop? Indian economy surges 8.2%. And my take on Google parent Alphabet, ticker GOOGL. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode 147 of the Stock Doctor podcast. We are in December, and that means that Thanksgiving was over last week. And hope all my US listeners enjoyed a lovely Thanksgiving with your families and your loved ones. The markets certainly were in festive cheer. They were certainly in festive mood as they wrapped what was a holiday shortened trading week. Remember, with Thursday was holiday in the US markets, Friday was half day. So it was essentially a holiday shortened trading week. And the markets also wrapped up November on a very positive front. One more record was broken, and this time it was a solid record, as the S&P 500 moved from down 4.4% on November 20th to finishing November in the green, to actually turning positive for the month of November. So in 10 days, 10 calendar days, not 10 trading days. Remember, it was a holiday shortened trading week. So it was on November 20th. S&P 500 was down 4.4%. By the time we hit November 30th, by the time the holiday shortened trading week was over, it had already turned positive for the month. So it was an absolutely wild swing, and this was yet another record because it was the largest swing for the month of November ever. And what does it mean? It simply means that the markets continue to demonstrate how much volatility there is in and how much how uncertain investors are. Nonetheless, at least it was the good news is that the record was a positive record. It was at one point, it was heading to be really, really bad for the markets, but at least the S&P 500 finished the week in the green. NASDAQ, however, did not. It finished the month in the red. Once the dust had settled on the week and on the month of November overall, all three indices firmly finished in the green. Dow jumping 3.2% for the week, S&P 500 surging 3.7% for the week, helping it to turn positive for the entire month of November. And the tech-heavy NASDAQ, despite a whopping jump of 4.9% for the week, did end up November in the red. So not exactly happy news or happy days for the tech-heavy stocks. I mean, which is kind of not surprising given how people are a little nervous about the AI bubble deflating or bursting or whatever other colorful adjectives you want to use, right? We've got a lot to talk about this week because it's a lot of economic data, even though it was a holiday shortened week. So let me quickly welcome you to the first segment, Doctor's Weekly Snapshot, and take you through the key developments of the week. As I said before, despite a holiday shortened trading week, investors certainly had a lot of economic data as well as comments from Fed officials to take to their respective Thanksgiving dinner table. I'm sure the Thanksgiving dinner table would have had a widely ranging conversations if you were an investor, because it would have led from the Fed to crypto to AI. A lot of topics to discuss, a lot of colorful insights was provided by the month of November. So while you're munching on the turkey, I'm sure there was a lot of colorful conversations on the economy, but on the US economy overall. There was a lot of economic data that you would have received even though we only had 3 full days, a holiday, and a half day in the week. One common theme, though, that emerged from all the data and the comments was that all of them pointed to a Fed rate cut in December, which is probably why markets ended the week on a high. Remember last week, as in 2 weeks back, on the last episode, I said that, possibilities of a Fed rate cut are slimming. The odds have significantly decreased of a rate cut. That has completely changed. Just again, further demonstrating how fickle investors' expectations are when it comes to a rate cut. For instance, we got the long overdue September Producer Prices Index, the PPI report, and even though it was a stale report, it did give a lot of indications as to where inflation was heading. The report more specifically, the report primarily indicated a muted rise in the Fed's preferred inflation gauge, despite headline increases driven by volatile food and energy costs. While the Producer Price Index itself rose 0.3% for the month, core components means you exclude the food and volatile things like food and oil prices. They do suggest a softening inflationary trend that may actually influence the Fed's upcoming interest rate decisions. You have to keep in mind, though, that PPI plays a crucial role in feeding data into the personal consumption's expenditure, or PCE index, which is what I call, or which is what the street calls, the Fed's key inflation gauge, one that it relies on when it comes to making decisions on whether to cut or raise rates or whether to do nothing. So the fact that core PPI, which excludes, like I said, which excludes the volatile food and energy prices, had the mildest annual increase since July 2024 actually bodes well for the PCE data, which is set to be released when? This Friday. Okay, remember the Fed's meeting is next week, not this week, and the Fed will only get the PCE metric as the only inflation data heading into the meeting. So set to be released Friday, and this meeting, even though it is a delayed PCE report, it does show that the indications, the takeaway from the PPI report is that the PCE index might actually come in cooler than what was initially expected. So, and given that, like I said, given that this is the only inflation data that the Fed will have heading into its meeting later this month, it certainly boosts the odds of a rate cut in December. We also got the Fed's latest Beige Book, which is nothing but a survey. Okay, it's basically an anecdotal look at the U.S. economy, and this supposed Beige Book, or the Fed report, however you want to call it, is constructed using surveys and interviews by each of the Fed's branches. Very, very vital. I don't care what terminology you use. All I want you to know is it's a very, 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 very vital piece of information, and kind of gives you insights into what the officials are thinking and into what data officials have regarding US consumer, US economy, and so on. And while the book describes persistent inflationary pressures, the latest report describes persistent inflationary pressures, it also mentions a weakening job market. More specifically, hiring appetite fell in half of the Federal Reserve's 12 regional districts. In the Atlanta's Fed's region, businesses were either cutting staff or hiring only to replace the departing workers. Across most of the country, companies reported that it is becoming much easier to find workers, indicating that the so-called leverage, which was in the hands of employees, is slowly slipping away. And that can only mean one thing: the labor market is certainly deteriorating. The Beige Book has also revealed that while AI has led to booming investment in infrastructure, it has also dampened hiring for entry-level roles in companies leaning on technology. It has dampened hiring for entry-level roles as companies lean on the technology for basic tasks. Some students are even avoiding fields like data science out of fear that AI will eventually replace their jobs. So again, all signs are indicating to a weakening labor market. And then, so you got the PPI data, which shows inflation is much better. Inflation is a lot better than what was initially expected. So in this dual mandate of battling inflation and labor market, clearly the signs that labor market is weakening is gaining more and more weight with each of the economic data that we got last week. And then finally, if you're not happy with just the economic data, you got to hear straight from the horse's mouth about the possibility of a December rate cut, as more Fed officials, including allies, and this is the key thing, including allies of Fed Chair Jerome Powell, came out and spoke in favor of a rate cut in December. While there was still a significant division within the committee, which is expected to set a record number of dissent at the December meeting, the last time there was a vote with more than 3 dissents was way back in 1992. 2025 December is expected to break that record. So the likes of New York Fed John Williams and San Francisco Fed President Mary Daly, on the other hand, both batted for rate cuts in December, pointing to a weakening labor market. Mr. John Williams, is considered to be very close to Fed Chair Jerome Powell, and markets are currently of the opinion that he wouldn't have spoken without Chair Powell knowing about it in advance. It is on this basis that markets believe that a rate cut in December is possible, or certainly the odds of a rate cut in December has certainly been boosted, and this was further evident by a sharp jump in the odds of a rate cut to 70% from 40% immediately following Mr. Williams' comments. Just goes to show again the fickle nature of investors' expectations when it comes to a rate cut, how badly they are craving for a rate cut in December. Now, don't get me wrong. Despite all of this economic data pointing to a rate cut in December, we got 1 week's of economic data pointing to a rate cut in December. Don't get me wrong. The decision continues to be a toss-up. It is absolutely 50-50. It can go either way. Even though only a 7-5 majority is needed, it can go either way. Like I said, this is probably going to be the first meeting since 1992 that would have a lot of dissent one way or the other. Okay. All I'm saying is one thing is very clear. The combination of a weakening labor market and persistent inflationary pressure has sucked the joy out of the US consumer. And we are into holiday season, guys. 1st December, the time of recording, this is 2nd December, not 1st December. Already, December is already upon us. Yeah, all I'm saying is it sucked the joy out of the US consumer. It was very clear from the findings of the Beige Book, which showed that consumer behavior consumer spending showed a distinct pullback, particularly among those without high income, as household budgets tightened. So essentially, the spending also has seen a distinct pullback. We also received the September retail sales numbers, which further confirmed that consumers pulled back on purchases in key categories. Retail sales for September rose 0.2%, falling short of expectations of 0.3%. Consumer sentiment also deteriorated significantly in November, reflecting growing anxiety about the economic outlook and job availability. The perceptions of the job market worsened, with the share of consumers viewing jobs as plentiful has now fallen to 27.6%. From 28.6% in the prior month. Finally, to make matters much worse for the labor market, data from payroll processor ADP indicated that private sector employers shed an average of 13,500 jobs per week in the 4 weeks ended November 8th, further signaling a potential stalling in job creation ahead of the critical holiday hiring season. I know I've taken you through a lot of data numbers and commentary for the normal week, let alone for a holiday shortened week. When I go through all of this, okay, if you're going through all this, when you're connecting the dots with all this data and the commentary and everything that you've been receiving, personally, if you ask me, I think the Fed needs to go for a rate cut in December. I know inflation is sticky, but it's not running away. The job market, on the other hand, is clearly showing signs of weakness. And with AI already having a negative impact on entry-level jobs, the focus, in my view, needs to be on making sure the labor market doesn't crumble. Simple question. I don't need to be an economist. I don't need to have a PhD in finance. I don't need to have all this, and I don't need to have that investor mindset. It's very simple to answer this particular question. Without jobs, how on earth do you expect US consumers to pay for anything? I'm not talking about Christmas gifts or anything, but for anything, basic essentials. As such, the labor market, based on that logic alone, one can clearly argue that the labor market must take precedence here. And as such, if I was in that Fed, if I was chair, I would be going for a rate cut in December. And especially if I'm working in a Fed that calls itself or prides itself on being data dependent. Data is clearly showing labor markets crumbling. Data is clearly showing labor markets breaking. Based on that logic alone, if you don't have a job, how are you going to pay for it? How are you going to pay for anything? A rate cut in December is certainly warranted, in my opinion. The US is clearly going through an affordability crisis now, but what is more worrying is that the negativity surrounding the labor market, as well as a massive hiring slowdown, has the potential to make this crisis even worse. The Fed, in my view, has done enough waiting and watching. The time to act, ladies and gentlemen of the Fed, ladies and gentlemen of the voting committee, the time to act is right now. On that note, I'm going to take you straight to India. In our next segment, the doctor goes home, where the mood and the picture is completely different when you compare to the US. It's polar opposites. Okay, there's only one thing to discuss from an Indian investor's perspective, and that's the Q2 GDP data, which smashed all expectations and further lends support to how strong the Indian economy has been, even in the presence of a whopping 50% tariffs from the US. Remember, the tariffs have not gone away. Okay, the resilience shown by the Indian economy, despite that, is what was evident in the latest Q2 GDP data. Let me give you some further context. India's GDP grew at 8.2% in Q2 FY26, and that's the July to September quarter, significantly outperforming the 5.6% growth recorded in the same period last year and smashing all estimates. The secondary sector expanded by 8.1%, driven by robust manufacturing growth of 9.1% and construction sector expansion of 7.2%. The tertiary or the services sector also demonstrated a strong momentum. In fact, it demonstrated even stronger momentum with a 9.2% growth led by financials, real estate, and professional services, which grew 10.2%. Primary sector activities, which included agriculture and allied sectors, grew 3.5%, with 2024-25 agricultural output indicating a record harvest. Furthermore, unlike in the US, the Indian consumer has no problem spending. Private final consumption expenditure strengthened to 7.9% in the quarter, up from 6.4% during the same period previous year, reflecting improved consumer spending. The GDP data further confirms that the structural reforms undertaken by the Indian government is clearly rubbing off on the Indian economy. The GST 2.0 reforms, I've spoken plenty about this, which were implemented actually ahead of the festive season, clearly stimulated demand and supported production levels during the quarter. The blowout GDP data has led to future GDP revisions as well, and all for the upside. So again, yet another positive development. For instance, CRISIL has revised India's GDP forecast for a current financial year to 7%, up from its previous estimate of 6.5%, following the robust first half performance of 8% growth. Chief economist Dharmakriti Joshi of CRISIL noted that Q2 real GDP growth reached 8.2%. Significantly exceeding expectations, with nominal GDP coming in at 8.7%. HDFC Bank raised its FY26 growth estimates to 7.3% from 6.8%, assuming a favorable trade deal is reached by the year end, which is completely it's completely doable. I already talked about this last episode. Though HDFC Bank does expect second half growth to moderate to roughly 6.6% as base effects fade. SBI Research termed the current Q2 GDP growth as a juggernaut, emphasizing that the economy is driven domestically by value-added expansion in labor-intensive sectors. Industry leaders and institutions also highlighted that the latest GDP growth underscores the depth of domestic demand and the adaptability of manufacturing and services sector despite global headwinds, primarily from the US tariffs. The key question for Indian investors like you and I now is, what on earth would the RBI do? After indicating that this caused further room for a rate cut, the stronger than expected GDP data is certainly going to cause the central bank to go back to the drawing board and analyze once again whether a rate cut is actually warranted here. According to the SBI research report, the final readings of the strong Q2 growth data have actually dampened the case for an immediate rate reduction. The report indicates that the broader monetary policy landscape has entered a phase of pause, with varying approaches across different geographies. Instead of direct rate actions, SBI research suggests that the central bank may focus on affirmative actions outside the policy space to support the economy. Personally, you ask me, I'm doing a full reversal. Okay, I'm doing a full reversal based on compared to my views on the US economy. Unlike the Fed, I am of the opinion, I support the SBI research report. I am of the opinion that's actually best for the RBI not to go for a rate cut at its current meeting and adopt a wait and watch stance. I told you, complete reversal. The Fed, I expected to wait and I'm done with its wait and watch. I wanted to undertake a rate cut. RBI, on the other hand, I wanted to go to a wait and watch mode because of this, based on this latest GDP data. Data dependent, guys. All about data dependent, right? Are there risks to this economic? Are there risks to the economic juggernaut in India? Of course. You've got rising input costs, widening trade deficits, continued threat of the 50% tariff, and no trade deal in sight, to name a few. But with inflation heading in the right direction, labor market humming along smoothly, and the overall economy powering through despite all the headwinds, not cutting rates in the December meeting is a move that the RBI can actually afford to make. Should there be no progress on the trade front with the US by year end, RBI can certainly revisit a rate cut at its next meeting. Between now and then, in my opinion, in my view, there is unlikely to be any major shock that would undo all the progress made by the Indian economy in the first half of the year. The RBI has certainly made some very, very smart moves this year. Make no mistake about it. The last thing that the central bank should then do is to shoot themselves in the foot and undo all the efforts that has propelled the Indian growth engine till date. On that note, I'm heading straight to the final segment, the Doctor Dissects, where yet another Mag 7 goes under the microscope. He got very excited, spilled some water already. Yet another Mag 7 goes straight into, under the microscope. But this is one that has been grabbing all the headlines in recent days, and deservedly so, in my opinion. The stock I'm talking about, ladies and gentlemen, is Google parent Alphabet, ticker symbol GOOGL, or Google without the E. Alphabet actually reported its Q3 numbers towards the end of October, and it had a fabulous quarter, in my opinion, comfortably beating the top and bottom line estimates. Most specifically, Q3 revenues came in at $102.3 billion. That's right, billion with a B, not a million, billion with a B, up 16% year over year and beating analyst estimates by $2.21 billion. Diluted EPS came in at $2.87, up 35% year over year, coming in at 30.5%, which can be attributed to a combination of a significant jump in R&D expenses, and beating analyst estimates by 61 cents. Operating margins declined by 180 basis points. Sorry, I fumbled up the numbers. Just to make things very clear, diluted EPS came in at $2.87, and that was up a whopping 35% year over year, and it beat analyst estimates by 61 cents. Operating margins, that's what I'm talking about, actually declined by 180 basis points or 1.8% year over year, coming in at a 30.5%, which can be attributed to a combination of a significant jump in R&D expenses, which is 22% growth, and a more than doubling of the general and administrative expenses, which is 105%, which saw 105% year over year growth, courtesy of a $3.5 billion fine imposed by the European Commission. Free cash flows, despite higher capital expenditure, still registered an impressive 39% year-over-year growth, with trailing 12-month cash flows coming in at $73.5 billion. Overall, all in all, I know despite the operating margin decline, all in all, it was a fabulous quarter, in my opinion, from Alphabet. Now, while specific guidance was not offered by the management, they did mention that FX is likely to be a tailwind to Q4 revenues, although the exchange rate volatility certainly adds to the uncertainty. Management also upped their guidance on CapEx spending, with total CapEx spend in 2025 now expected to be $93 billion versus the previous estimate of $85 billion. Furthermore, while CapEx spending in 2026 is expected to show a significant increase, let me put it this way, significant increase compared to 2025, management's words, not mine. Further details will be known only during the next quarter's earnings call. And this is management commentary. It's not something I'm making up. Now, obviously, this is the quarter numbers, the guidance, all of that. Now, let's go into the takeaway. The third quarter performance from Google was more evidence, in my opinion, the company can not only withstand the increasingly competitive landscape, but it can also use AI, the primary driver behind the so-called increasing competition, to adapt and grow even more rapidly. For instance, one of the primary reasons why Google stock went through a rough patch earlier this year was the thesis that the likes of ChatGPT and Perplexity would shift the search landscape, resulting in the end of Google's dominance. If the Q2 performance, if the last quarter's performance by Google dispelled this thesis, then Q3 actually showed that such a debate will not be occurring anytime soon. Not only did the company maintain its double-digit growth in search revenue, but the business also saw its highest year-over-year revenue growth in the last 14 quarters. That's 3.5 years. Okay, AI overviews and AI mode are certainly evolving into very, very strong catalysts for the search business. More importantly, management announced that AI overviews is gaining traction among the younger users, a demographic that was expected to permanently switch to ChatGPT or Perplexity, in the months and years ahead. That is not happening. AI mode has also seen very strong adoption rates with consistent growth in week-over-week usage, the number of queries doubling since Q2, and total daily active users of 75 million. The company's latest innovations, such as shopping capabilities in AI mode, in my view, should also help the company to continue to maintain its stronghold in the search business. Overall, Q3 offered more evidence that the search business in its new avatar has significantly more room to run, and news of its demise certainly greatly exaggerated. Q3 also saw a massive growth in Google Cloud as the segment posted double-digit revenue growth both on year-over-year, which is 33.5% growth, and on a sequential basis, which is 11.3%. The current quarter's growth means that the segment has generated growth in excess of 30% in 4 of the last 5 quarters. Operating margins of the segment, of the cloud segment, grew 660 basis points or 6.6%, coming in at 23.7%, demonstrating once more how the AI revolution has been a significant tailwind to the cloud segment, similar to other hyperscalers such as Microsoft and Amazon. Management during the earnings call also announced that the Google Cloud Platform now has a backlog of $155 billion. And while this figure falls short of its peers, the fact that this backlog grew 82% year over year and 46% on a sequential basis shows the rapid pace of growth of the cloud segment, driven by the very revolution that was supposed to kill it, the AI revolution. This brings me to one of the most trending questions that investors keep asking when it comes to the AI trade, which is the question related to the significant increase in CapEx spending by big tech to build out the AI infrastructure. The recent market sell-off, like I said, NASDAQ finished the month in the red, which started off with a post from Dr. Michael Berry of Big Short fame, has once again centered around the tech valuations as well as the perception of excess spending on AI. Now, I can make sense of the valuation angle to an extent, as this year has firmly belonged to the AI trade, to such an extent that even the Fed and President Trump, President Xi showdown were overshadowed by big tech earnings. As a result, tech valuations are certainly looking stretched. So market pullback is healthy in my view. In fact, they're looking much and more less stretched. As November went on, they look more and more less stretched. Given the fact that NASDAQ tumbled 4.9%. But I get it. I buy your valuation argument. That's fine. No problem. I cannot, however, make sense of the negativity surrounding the CapEx spending. Let's take Google's case. The company announced that the CapEx spending for 2025 would be in the range between 91 and 93 billion. To put this in context, that's 6 to 8 billions higher than its previous estimate. So it's not a substantial increase. I repeat, it is not a substantial increase. The market had already priced in 85 to, it was 85 billion. And now the previous estimate was 85 billion. Now it's 91 to 93. So that's a 6 to 8 billion, which in Google's context is a drop in the bucket. So clearly not a substantial increase. Furthermore, management during the earnings call once again emphasized that demand continues to outpace supply, which has been the case for a while now when it comes to these hyperscalers. In my view, the company is not exaggerating when it makes the statement, as evidenced by the significant growth in Google Cloud's backlog. There are other areas that support management's argument as well. For instance, all its AI tools are generating significant demand and popularity. For instance, using VO3, over 230 million videos have been generated. Gemini Enterprise, launched earlier this month, has already crossed 2 million subscribers. Finally, revenue from the company's AI products have surged more than 200% year over year in Q3. Then there is YouTube, through which the company's ads business has seen tremendous growth after showing a significant deceleration last year. Q3 saw YouTube ads generate their highest year-over-year growth since the first quarter of last year. In absolute terms, Q3 was just the second quarter in 18 quarters, that's 4.5 years, ladies and gentlemen, where the ads revenues actually crossed the 10 billion mark. AI played a significant role in the resurgence of YouTube ads business, just like it did with the revival of the search business. For instance, the company's AI ad tool Demand Gen has helped small and medium enterprise advertisers to improve their revenues, as the latest models have led to what is called as discovery improvement. Demand Gen has also led to a 40% increase in conversion value for advertisers using target-based bidding on YouTube. The company's AI tools like VO3 are also helping creators, which would mean more content, which translates to more ad opportunities. Finally, it's not what the company has done with AI, but what the company has plans to do with AI that further justifies this CapEx spend, this increase in CapEx spend, in my opinion. For instance, according to Bloomberg News, Apple is currently in the process of upgrading Siri by incorporating Google's 1.2 trillion parameter Gemini model, which is expected to generate $1 billion per year for Google. No surprises here, given that Gemini 3.0 has been a massive hit and is today considered to be one of the best models out there at this point in time. Can you imagine a scenario last year. Did you predict? I certainly did. Did you guys predict? Any of you predict? You can put it in the comment section if you did predict that Google's AI tool would actually be much better than GPT-5, for instance. They were going through crisis after crisis last year with Gemini, and today Gemini 3 is right up there. What is wrong with the spend? What is wrong with the spend? I have to take a pause. Moreover, the company has also announced new AI tools such as Ad Manager, AdSense, and AdMob, which are expected to boost monetization and automate work for publishers. In addition, while nothing concrete was announced, CEO Sundar Pichai hinted that the day is not too far off when Gemini would actually be integrated into Waymo. When and not if this happens, in my view, this would also turbocharge the company's robotaxi business. With the service, with Waymo set to be launched in London, yup, I love this. With Waymo set to be launched in London and in 3 US cities, including Las Vegas in 2026, the integration of Gemini into Waymo would be an absolute critical game changer, in my opinion. If one takes all of these developments, as well as the progress made by the company, thanks to AI, then I simply don't see a reason why investors should fret or worry about the company's capex spending, especially if the primary goal is to build out an AI infrastructure to meet the growing demand. Management is clearly not bluffing when they claim that demand continues to outpace supply. As such, investors, in my opinion, shouldn't punish the company based on this claim. Got a notebook ready? Got some numbers ready? Can only mean one thing: valuation. Stock valuation. Now to forecast, Google, we're going to go over the PE multiple basis. That's the calculations we're going to do. But to forecast Google's FY26, I actually deployed a machine learning model. More specifically, I deployed a long short-term memory LSTM. That is it. Yeah, there you go. LSTM neural network. Okay, LSTM neural network. It's a ideal recurrent neural network to process sequential data. Unlike traditional recurring neural networks, LSTM is actually able to learn as well as remember the long-term dependencies between data points over time. LSTM, unlike other neural networks, has something called a forget gate, which actually allows the neural network to decide which information is relevant and which information needs to be discarded. This improves its ability to predict, given that it is able to selectively retain or forget information. In addition to having the ability to forget old patterns that hold absolutely no relevance, LSTM also has the advantage of capturing nonlinear relationships, such as accelerating growth. To predict Google's FY26 EPS using LSTM, data on the company's historical EPS was collected from FMP Prep or Financial Modeling Prep. Data was collected for 93 quarters and was then normalized to the 0 to 1 range, a requirement when handling neural networks to avoid training instability. 8-quarter sequences were then fed to the LSTM model, which allows both seasonal patterns and recent trends to be captured. The data was then split into training and test samples, and the overall training configuration of LSTM was: you had the Adam learning optimizer with a learning rate of 0.001, mean squared, the loss function was MSE, which is the mean squared error, 16 sequences processed together, and a maximum training epochs of 200. Early stopping was allowed despite maximum epochs at 200. Training's early stopping was allowed at 13 epochs to prevent overfitting. I'm not expecting you to go through all these technical details about the neural network or the machine learning model. All I'm saying is some of the advantages of this neural network that I deployed, or that machine learning model that I deployed. Now, obviously, when you deploy a machine learning model, you've got to look at the evaluation. You've got to evaluate the metrics, right? Is the model good for predictions or not? So you have the usual: mean absolute percentage error, mean absolute error, root mean squared error. And this is what we got. So you got a MAPE, which is the mean absolute percentage error, 9.1%, which is excellent. Then you have the mean absolute error of $22 and RMSE of 27 cents. Both these figures are close enough and they're indicating no outliers. 9.1%, anything less than 10% is brilliant. So the model all cleared for testing, all cleared for forecasting. Obviously, we then forecasted, right? But before forecasting, what I did then is I introduced 3 scenarios: base, bull, and base, bear, and worst. Here's how I describe the scenarios. You had the base case whereby AI infrastructure materializes, revenue growth resumes its trend of exceeding the expense growth. Then you had the bear case. Surge in capex compresses margins, cloud sees an unexpected growth deceleration, R&D expenses drive expense growth ahead of above revenue growth. And then you had the worst case scenario, which is based all the problems of the bear case scenario, plus regulatory headwinds that actually delay the company's ability to delay AI monetization. CapEx continues to surge. And the probabilities are very straightforward. You had 50% probabilities for the base, 35% probability for the worst, and 15% probability for, 35% probability for the bear, and 15% probability for the worst. So 50 for base, 35 for bear, 15 for the worst. And this is how the projected EPS from the model comes in. You had 1384 for base case scenario. The bear had 1176. And the worst case scenario had $10.38. So what you then do is basically you do 50 into this, 35 into this, 15 into this, add it all up to get the weighted average probability, weighted average EPS, weighted average projected EPS for FY26 comes out to be $12.60. According to Seeking Alpha, Google currently trades at a forward price to earnings of 30. Okay, so basically what you then do is you multiply. Put the old EPS here. So let me just quickly change this. It's 30.45. So what you then do is you take the projected EPS 30.45, multiply that by the weighted projected EPS of $12.60, and you get a price target of $384. $384 actually represents 20% upside from current levels, and that could only mean one thing. I am maintaining my buy rating on Google. In fact, I am an investor. Google is one of my newest positions, so there is a standard disclaimer there. But overall, after all the technical jargon I've taken you through, the key takeaway here is I have a buy rating on Google, 20% upside with a price target of $384, which suggests a 20% upside from current levels. When I do a bull case, it can only mean one thing, and that means that I've got to talk about risk factors, especially since the stock is currently coming off some incredible momentum. It has a grade of A+ on Single. That's the highest grade. There's nothing more. So it's one of the best stocks from momentum perspective, according to Seeking Alpha. So obviously, I got to put the risk factors, right? The bull case. I got to highlight the risk factors because I have a tremendous bull case opportunity here. Primary risk factor to my bull case are the factors that I mentioned in the bear case scenario. More specifically, investors should monitor the expense growth in the coming quarters to see if it falls below revenue growth or if it grows faster than revenue growth, as was the case in the latest quarter. The other risk factor that investors should consider is whether the company continues to rely on selling debt to fund its AI infrastructure build out. More specifically, the pace of bond sales needs to be monitored. And it's something that the market has been monitored, and it's partly the reason why the AI bubble is showing signs of weakness. Finally, the model itself that has been used for valuation has limitations. The model provides point forecasts and does not provide any uncertainty bands. The model also has not accounted for major Google-specific risks, such as potential regulatory changes, product setbacks, or the magnitude of competitive threats, such as increasing competition to search. So those are the three risk factors. But like I said, 384 price target, 20% upside, buy rating on the name. Disclaimer, Google is my latest position that I have acquired. I am long Google. So bottom line, all I'm saying is Google had yet another phenomenal quarter, blowing past both the top and bottom line estimates. Every segment delivered, the search business registering yet another quarter of double-digit growth. Moreover, Google Cloud continued its growth trajectory, delivering yet another quarter of 30% plus revenue growth, as well as significant operating margin expansion. Google has leveraged the AI revolution to its strength, and its advancements in Gemini and ad tools are not only delivering significant growth, but are also primed to be significant growth drivers in the coming months and years. This, to me, justifies the company's plans to keep spending on building out its AI infrastructure. My LSTM neural network machine learning model implies a further upside of about 20% from current levels. And while technical signals indicate the company is in overbought territory, any meaningful pullback as a result of this should be considered a buying opportunity. I am maintaining my buy rating on the name and consider Google to be a must-have. And this is my words, not the management's words, in the portfolios of long-term investors. There were doubts surrounding Google and Alphabet and whether it missed the AI boat. The company's Q3 performance and its plans for the future, in my view, have dispelled those doubts comprehensively. That's all the time I have for you this week. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me on Uttam Vinay, UTHAMVINAY, or email me on the Stock Doctor Podcast at gmail.com. Thank you once again for listening. I'll be back again next week with a fresh episode. Until then, as always, stay safe and make some money.